Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Welcome, guys.
Hello, Casey.
How's it going?
Good. So today's podcast is sort of a quarter roundup, a year-to-date roundup. We got to make sure we keep it clean and understandable for our listeners. We tend to use a lot of acronyms when we get together and talk fast. It's been a wild and crazy 2 quarters in 2020, to say the least.
It has been. In all my years in this market, this one's been the craziest so far.
What are we looking at for performance, Brad?
Well, year to date, the S&P is almost back to where we started. We're off by about 2% at this point in time. However, at its low, it was down almost 33% at one point in time. And on March 23rd, it began to rebound. And since then, the S&P is up a little over 40%.
That's quite the wild ride.
That sure is. That sure is. Investors really have to be committed to their portfolios to stay in this.
So it's interesting to see when we look at what's happened year to date. You know, when you build portfolios, you build them to last through the black swan events known as surprises that can just pop out of nowhere. Certainly that's what COVID did for us. We weren't talking about that in December at all. Even at the beginning of January, it was something that was far away from us, wasn't here. What are some lessons you think we've taken from this volatility that we've experienced?
Well, I think that one of the main lessons that we can take from this is that risk in the marketplace happens fast. As you're saying, in January, we weren't even considering this. By February, we were gripped with it. And by the end of March, the stock market had gone down 30-some%. That's fast. The markets, however, react even faster. They're anticipating risk that's occurring, that's about to occur in the marketplace. So as we realize risk in real time, we watch the news, we talk with everybody else, we're reading in the newspapers, and we see risk happening. The markets have already anticipated that risk. And that's why we saw the market drop precipitously. In 23 days, it lost over 30%, which is unprecedented.
Yeah, well, that was, March 23rd was when the low was?
Yeah, March 23rd, generally thinking, is that the market high was on February 19th. That's 23 business days.
Yeah, I know that it dropped 30%. That's also, and the quick recovery, making it one of the best and one of the worst quarters since 1926. Quarter 1 was down over 19%. Quarter 2 had a turnaround of over 20%, and that's how we get to the total return for the half the year. That's just over down 2%. So lots happened in the last 6 months, and especially in the last quarter with that quick turnaround. The Dow had the best quarter since 1987, and the NASDAQ hit record highs, surpassing the 10,000 mark and having its best quarter since 1999.
And I think that's indicative of the type of bear market that we just experienced. There's generally thought to be 3 different types of bear markets: structural, cyclical, and event-driven. COVID was definitely an event-driven bear market. And event-driven bear markets are noticeably different from the other two in that they are shorter and steeper in the bear market and the rise out of that bear market. And that's what we're seeing this go-around as well, I think. So it's playing according to tune that event-driven bear markets are shorter and occur at a much more rapid pace.
You could have an event-driven bear market, though, turn into more of a cyclical or a structural.
Absolutely can. If the event itself isn't corrected, this can go on for a much longer time and actually turn into a structural bear market and structural recession, which would be a huge concern.
That goes back to March 23rd was the low, and you look at where we are now, that almost seems impossible that would happen like that. But what really triggered that is all of a sudden was globally stimulus came out of everywhere. During the financial crisis, we were really slow to react. We were looking at one company at a time. Do we let it fail? Do we let it, do we prop it up? Some companies failed that we probably should have propped up, and there's companies that we propped up we probably should let fail. It seemed to be that playbook this time was very quick, a response. Although we had that week and a half there where we didn't pass a stimulus, and then everyone's trying to get their earmarks added to the plan. Then selfish politicians, basically, both sides of the aisle, not doing the right thing. But eventually they did. What I find interesting is half the stimulus, now I'm talking about not just U.S., but global stimulus, half the governments of developed countries, that stimulus was issued as guarantees to loans and also loans. And so a lot of times what I think about is, well, how do you unwind globally $9 trillion, right? So if part of that was spending, so $4.5 trillion was just spending, you don't really get that back, and then another $4.5 trillion was loans and guarantees. It took 2 years for us to get out of the financial crisis and unwind all the positions, right, that we had that the government had. So maybe it's not as bad as we think it is with the stimulus, because assuming that there aren't massive bankruptcies on these loans and guarantees, the government gets a lot of that back over time. In a Vanguard article I read recently, it says we shouldn't focus so much on the amount of money, but the payments on that money related to economic growth. So it's going to be interesting to see how that plays out.
Yeah, I mean, the Fed even stepped in and did something unprecedented and started backing fixed income ETFs. Started with the corporate ones and then even some high yields as well. They approved for $250 billion, but they've only used currently about $6.8 billion of that in certain about 16 fixed income ETFs. And now they're talking about moving forward to individual issues as well. But that's what they've recently been doing with that secondary market corporate credit facility they opened, just to provide some liquidity into the market by backing certain ETFs.
And by the liquidity, I guess to explain to our listener, that basically just means that funds are available for these corporations to do business.
Right.
You don't want an environment where all of a sudden your ability to get access to fund your paychecks all the way to funding growth, new products for your company dries up.
Right.
And
they've done a lot of, like I said, it's only $6.8 billion of that, and they've got a runway for a lot more should we need it.
And what they didn't do during the financial crisis, what they're doing now, even high yield bonds. So they're buying the most risky bonds also to prop those up with liquidity, which I find very interesting.
Well, given that they have not used the entire credit facility, amount yet,
right,
it's almost as if the offer or the guarantee that we're going to make available this money has been enough to shore up, the fixed income marketplace. So I think that's really very interesting that we didn't have to actually spend all that money, as you say, just making the offer or making the guarantee that if necessary, we'll spend it. And then the rest of the market took that as a cue and began functioning properly.
Right.
Yeah.
Right. They definitely wanted to get ahead of it should we need it. Like you said, a little slower acting in 2008, make sure that wasn't happening again, and they were quick to act and make sure they had everything provided to get ahead of it.
And the Fed, who's, in my opinion, continually gotten the interest rates wrong, has said we're not going to do anything until probably 2022.
Well, they said that the way they characterize it, we're not even thinking about thinking about
until 2022. So for people struggling with credit card debt on a variable rate, that's a good signal.
Yeah, sure
you have
is.
less interest, right? But for most of our listeners and people that we work for, that just means that your savings accounts are going to pay even less than before. CD rates are very low. I don't know. I struggle with that. I guess the economy obviously needs it, but the projected return for a 10-year treasury now, or just treasuries in general, is around 1%, right?
Yeah.
Over the next 10 years. 10 years, 1% on your secure bond portfolio. That's crazy. So I think that really reshapes us and how we build portfolios going forward.
I think so. I think it has to be a consideration for every portfolio and every investor out there as to what role is my fixed income going to play in my portfolio? What's it going to do for me going forward? And how do I make the adjustments in order to incorporate that change now?
Yeah, I think that we have to look at fixed income in a portfolio no longer as income producing. We have to look at it as our safety net. It's our rock solid foundation. So as we think about the next 10 years, when you look at the fixed income side, your thought is, hey, how much yield am I getting on that? It shouldn't be that. Really, it should be more focused on, okay, by adding this treasury to my portfolio, I'm going to reduce my downside by X%.
Yeah, I
right?
think that's why there's been a lot of articles called the death of the 60-40 portfolio, mentioning that how they're playing a different part of the portfolio now, and you got to transition to what the bonds play within that.
Right, absolutely.
Well, years ago, fixed income did provide a return in a portfolio. And so that could be part of, the rest of the portfolio's calculation. Going forward in a zero interest rate environment, we know that it's probably not going to provide much return. So therefore, the rest of the portfolio has to make up for that.
So there are other areas of bonds, high yield bonds, there's emerging market bonds that you can add to a fixed income portfolio. But what's interesting about those particular types of bonds is they have almost as much volatility as emerging market stock and small cap stock.
They're highly correlated.
I think when you look at the portfolio, you should be able to look at your bonds and go, okay, well, if we have a repeat of 30% loss, I want to look at my bond side and see all green. I don't want to see any red.
Yeah, another type of diversification away from equities almost.
Exactly. And then we have to look at our equities and okay, what's the yield on my equities? Robert Shiller, famous professor, has the Shiller Index. He's still saying stocks are way overpriced in our current environment. But I kind of look at it and go, where else are you supposed to go?
That's right. Right. There is no place else to go at this point in time.
Perhaps his model, and he's a very smart man, but perhaps his model is not quite taking into account a 0% environment for an extended period of time.
And that may be the key. That's the extended period of time. It is true right now, but when we're making these capital market projections, theoretically we're way out there in a number of years. But as we talked about earlier, they're not even thinking about raising rates. And even when they begin, they're going to be very cautious. We saw the past couple of years as they tried to increase rates, how tumultuous the markets became during that period, and they'd have to back off or slow down. Now with even more money in the system that's being propped up the equity prices in some instances, they're going to have to be even more cautious.
So if we should think about our bonds as safety, then that means that when we look at stocks, we have to be willing to accept the volatility. That goes back to one of our podcasts that just launched last week, was on our own financial behavior. And that means that we have to be able to ride through the rough patches. I think I read a State Street economic report, maybe it was yesterday, basically said we've looked at going around it, under it, and over it, but the best way to get through this market is through it. I think that's very true. We're just going to go through it.
Well, if the risk factors have changed given this environment of low interest rates, then at a total portfolio level, though, we can still manage that in order to stay within the risk parameters, given that we believe that the fixed income side of the portfolio has a more of a capital preservation approach and a lower risk mode than if the equity side has a higher risk mode. The two together can still have a risk median that's acceptable to an investor to achieve their objectives.
And it depends on where you are as well, where you are in life. So if you're 20, 30, 40, and you're working and you're putting most of your money into a 401k, does any of this really matter? I mean, if your job's secure, I would go back to its basic principles of finance. You should always have a reserve. And then as long as you have that reserve, you're good to go putting money away for your future self. And you should be, 90, 80, maybe 100% stock. And you just keep dollar cost averaging. Every paycheck you're putting in whatever percentage you choose to put into your 401k plan, you just keep saving. You're buying the dips. You want to buy more shares per dollar. So if your portfolio is always up, every time you buy, you're buying less shares per dollar, right? Ideally, you want to retire as it's all going up if you want to time it perfectly. But these dips and these sell-offs, we were screaming through social media, don't sell, buy more. And it was fun to see that. It was fun to get the phone calls going, hey, I can put an extra $1,000 in this month, or I can put an extra $500 in this month. And that was great. And I even hear at our firm, just in their 401k plans, which gets me excited, because that the future return on that, already they had, well, theoretically, depending on when your payday was,
right.
You probably had at least a 20% rate of return on that $500 or $1,000 that you got put in
back in March. Sure.
Right. Absolutely.
Yeah. And we refer to that as dollar cost averaging.
You're right. Yeah.
We've known about this for years.
Right. And compounding, which is free, right?
Exactly.
Compounding's free as long as you have time.
Eighth wonder of the world.
You mentioned investing. I mean, you don't have a whole lot of other options right now, unfortunately. Where you can go to cash or something that's yielding less than 1%. It's not the 70s and 80s where you get double-digit returns on fixed income and cash. You're returning basically next to nothing. So you might as well have a diversified portfolio. Well,
right now in this news cycle environment, there's a lot of fear that's being spread, but you don't see that in the stock market since March 23rd, right?
Right.
You don't see that fear in the market. The market's doing its own thing outside of all these other things that are happening. We're about to go into an election year, and both sides of the aisle are going to scare you into voting for them versus the other side. And we have to separate our investments from all that word volatility.
noise.
Well, that's true. And if the markets thought that this was going to be a long-term problem, they would be anticipating it, as we spoke earlier.
Right.
Okay. And they would actually be reacting now to something that may occur in the future relative to the social volatility that we're seeing out there.
Well, what you mentioned maybe earlier in the podcast, or maybe it was a conversation we had offline, what JP Morgan, State Street, BlackRock, Vanguard, and some other people that we reference in portfolio building, their market assumptions have increased.
That's right.
So stock assumptions have gone up. Bond return assumptions have gone down for the next 10 years.
Right. And for investors who use those models, they should be adjusting their portfolios to incorporate these new capital market assumptions, that you're going to get less from your fixed income portfolio. So we need to shift more towards the equity side of a diversified equity portfolio in order to get those returns to meet those objectives,
right,
that you find in a financial plan.
So going back to my age example, if you're already retired, then you need to make sure you have 2 years worth of income sitting on the sidelines that's not invested anywhere. And that way you can overcome this volatility because you know you have this safety net built. And that's one of the principles of our financial planning process, is making sure that we have reserves set aside, that money's not going into the market and all of a sudden we need it tomorrow and it's March 23rd, right? You never want to be in that position. And that's where bonds help us as well in the portfolio, because we know that we could always go to those treasury bonds and withdraw if we had to, but never have to touch that stock when it's down. If we want to dive a little deeper, the capital market assumptions. So these are different asset classes. So it starts with large cap US, mid cap US, small cap US, foreign developed countries, and emerging market countries, Brazil, Russia, China, India. Those valuations are very interesting to me because large cap stocks in the US have performed exceptionally well over the last decade. I find it interesting that in most capital market assumptions by the large firms, they put a little more weight on international, that international stocks could outperform over the next 10 years with volatility. I believe that the last Vanguard report that I had showed global equities, not including the U.S., 8.5% to 10.5% rate of return per year over the next 10 years, but with 18% volatility. So it's going to move up and down from those numbers by 18%. So you're taking on some risk there. And in comparison, U.S. equities, 5.5 to 7.5% rate of return over the next 10 years with 17% volatility. Now, these are just people, smart people, that are planning, say, hey, this is what we think would happen. It doesn't mean it happens this way.
But what are they basing that off of? Wouldn't a lot of that be earnings?
Yeah, possibly.
Which aren't even available right now.
Yeah.
I mean, over 180 companies, the S&P, which
True.
do their earnings forecast.
They're not forecasting it for the next year. This is a 10-year outlook.
Right, for those capital market assumptions, but just for you said the market was still overvalued by other analysts.
Oh,
apparently.
yeah, correct.
I mean, they're basing that off something that's unknown right now.
That's very true. That's very true. A little different angle, looking at more short term.
Right.
But yeah.
But I think it has to be considered that in a zero interest rate environment, I keep going back to that because this is such a strange phenomenon that we're seeing ourselves in. And a projected zero interest rate environment, all those calculations that go into creating a capital market projection have to be reset at zero interest rate. Meaning that if we did nothing else with our money, we could invest in a bank, CD, a treasury, or a money market and get somewhere in the neighborhood of 0 to 1%. So when you put that into a calculation, future earnings and future dividends, even if they're not being what companies sharing their projections right now, you can still calculate beyond that and say those dollars in the future are going to be worth more when I compare them to a zero interest rate environment.
Yeah. The other side of this too is if you have a zero interest rate environment, we already talked about, with the bonds, but then as interest rates will increase someday, eventually that people reset. They go, oh, I can get 1% now in a bond, or I can get 2 or 3 or 4. And so we saw that in the rebound from the financial crisis. It took almost 8 years to get there, but we saw periods where stocks would sell off as interest rates were rising because people were in the stock market who really didn't want that risk. They're just for the yield, and they moved back into bonds. Now we have this flip in our portfolios now, where we're really kind of back to where we were after the financial crisis. And so now the question is, when will interest rates rise? What kind of bonds do I need to have in my portfolio to be able to get over that hump? And I think most people are going to say short-term U.S. Treasury is the best place to hide from rising interest rates. So it's going to be interesting to see how it plays out. I think something that, Brad, you mentioned earlier too, is government stimulus. I mean, we have to have more government stimulus more than likely to get through this.
Yeah, and Congress has already passed a $3.5 trillion stimulus spending bill. Now, it has not been moved to the Senate for a vote yet, but we'll see that something will probably come through this. And that stimulus is going to create an even larger tailwind for investors. So we know that this is going to provide an even greater boost to the markets that can be, we can profit from, essentially, as an investor. The money supply has increased at a greater rate than ever before. It's increased somewhere in the neighborhood of 25% this year alone, which was something we've never seen. Now, Casey, you talked a little bit earlier about how do we begin extracting that money out of the economy at some point in time? And that's kind of the big economic unknown at this period. I think that they're hoping that by stimulating the economy, we grow our way out of it, and so that they don't have to withdraw it. It just goes down as a proportion of the overall GDP in the economy. That would be the greatest way for everyone if that were to occur.
So shifting gears a little bit, what we're talking about is, outlook for 10 years, but we think about the next 6 months. So I think it's a good thing that I don't get paid to make 6-month stock market predictions because I'm not always the best at doing that, right? It's a little bit like gambling at that point. But we have to understand what's happening in the short term so we can give advice should we need it on the short side, but also understand how that affects long term as well. I think that we have to acknowledge that COVID cases are increasing, although death rates are decreasing. So we have a younger part of our population. We've all kind of taken turns being out of town for a week or so. We've all come back with the same stories that evidently there was no COVID in Florida because everyone's just hanging out on the beaches and the restaurants, right? Go to a restaurant, someone's wearing a mask. I get a little anxious when I hear New York accents because I'm like, I don't know where you've been. but it's everywhere, right? However, there's all this rhetoric about shutting the economy back down again. And if I had to put a percentage on that happening from a federal level where it's like mandated, I'd put that at like 10%.
Yeah, I was going to say very low.
I don't think we could do that again, but they are starting to reclose restaurants and other bigger gatherings that they had hoped for. That would
state by state, though.
Right.
Not from a federal standpoint.
I think on a local level, adjustments will be made as new data, new information comes to the decision-making politicians and our officials, they'll make adjustments, and that's okay. I think we would expect that.
So I think our success over the next half, I think the consensus amongst every report that I've read that is a boring economic report, not your CNBC entertainment reports, basically showing a positive market or positive economic growth, I should say, over this next half as we come out. I guess somewhat like a V-like recovery, but maybe it starts flattening off. It's a V with it starts shaping into a lowercase r, maybe. But it really depends on how we strike a balance between public health and the lockdown and keeping things open. So
Yeah, I think you're right. I think that we'll probably see a net overall decline in GDP on an annualized basis for 2020 with a negative GDP for the first half and a positive GDP for the second half. Second quarter is going to be very difficult to overcome and go positive for the year on a GDP basis, I should say.
On a economic gross domestic product basis. Yeah, I think most are calling for about a 10% decline for the year, which is pretty remarkable considering you had a 30% drop in one quarter, or estimated 30% drop in one quarter. Yeah, the other thing too is the vaccine. So if we get a vaccine, what does that really do? If we get a vaccine, are you all of a sudden going to go, let's go to a concert because there's a vaccine? Just with our children, we think about all this information about, do we vaccinate our children with these new vaccines, and they have all these, they supposedly have all these bad side effects, and are people just going to run and give me the vaccine? I don't know that I'd want to take a new vaccine that hadn't been fully, that was on the fast path. I don't know that I'd sign up for that.
Hopefully we find out soon enough, but I think it would help though. You have to provide peace of mind for some people to get out there.
I guess so. Yeah.
I mean, even if the people that haven't been able to go outside were able to go outside or be around their family members because they feel like they're safe now.
Yeah. And it gets back to, I think we have to continue to look at the stimulus packages. Are those going to be enough to mitigate any negative impact for us? I think that is really depends on industries. Airline industry is getting torn apart right now. Hospitality, restaurant industry. Although we see some bookings again on airlines, more bookings for hotels, obviously. I think that's a sector you can really watch. If you start seeing that increase in demand, then you probably know that things are starting to heat up again. Something that probably our clients and even us don't see every day as we walk down the street, but it's just central bank programs and keeping businesses liquid. That's going to be important. Anyway, I think it's going to be an interesting 6 months. We haven't even talked about a presidential election yet and all this. And it's really not even talked about in the media really that much. Everything's COVID.
Tariffs. Remember last time that was mentioned?
Right, exactly. Obviously, we have other issues that are taking front page of the news, but we also have some other really important things we have to discuss as a country, and those seem to be ignored right now. Guys, do you have anything else you want to add?
No, just looking forward to the next 6 months. It's going to be interesting.
I think I'll add one last thing is that you have to be focused long term. You can't get so fixated on these short term market swings. We could probably set new records in the last half of the year, just as like we did in the first half of the year. And we're just going to have to go through it as opposed to trying to react to it. It's very hard to react and become a market timer and get it right. You got to be right on the front end. You got to be right on the back end. But we know over this 10-year time period, I would argue even 5 years from where we were a few months ago, that the market's always positive. Never lost money over 10 years. And we have to continue to focus on those stats and say, okay, the market's always given us positive returns, but we have to have the right behavior to be able to do that.
Yeah, there's going to be a lot of noise in the future, but it's important to realize the economy's not the stock market, and also the market's not the economy. So there could be some back and forth with each of those ups and downs. But like I said, focus on the long term, and if we can get through this short period of the health crisis, then we should be able to move forward.
All right, guys, enjoyed the talk. See you next time.
Thank you.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.